Welcome back. You're watching Investors Guide. Thank you so much for tuning in. We've asked Feroze Azeez to join us today and answer some of the questions you asked on asset allocation. Feroze, thank you for joining us.
Thank you.
Our first question comes in from 27-year-old Rohit. He's written in, he wants to put aside 5,000 rupees every month in mutual funds. And here's the interesting thing. He says he's investing for the long term of 5 years. Now, Rohit, if you're only 27 years old, long term, in my book, for you would be 30 years. You should be investing for the next 30 years at least. Now, if you're investing in equity mutual funds, you want some sort of a strategy. My advice to you would be to start small and then slowly add more and more funds to your list. But Feroze, what would you recommend he does?
Rohit, I think it's a very good thing that you're starting off your investments, especially in the equity orientation, which you have exhibited as an interest. I think your age definitely favors being into equity, and I think if you have 5,000 rupees to invest, in my opinion, you should look at equity and use your PPF and other debt instruments, like if you have a PPF that could form a debt portion. On the equity side, I'll recommend you two good equity mutual funds which you can consistently invest and upscale it as your disposable incomes go up. One would be a Religare mid and small cap scheme, which is a mid cap scheme which actually invests in stocks which are potential large cap, which might be smaller today, but they would turn to be large cap companies over long periods of time. So Religare mid and small cap scheme is one of the schemes, and the other one would be Mirai Asset India Opportunities Fund, which is managed in the large cap space, which invests in stocks which are larger in size. Gopal, the CIO, has done a brilliant job in actually doing a bottom-up stock picking on the large cap side, which is a tough task, but he's done it very efficiently. So these two schemes consistently, if you keep investing, discipline is what I would suggest as the core prime requisite to make sure that your maturity amounts are large enough.
Our next question comes in from 31-year-old Ganesh. He tells us he hasn't begun investing yet. Don't worry, Ganesh, it's never too late to start investing. Now, he plans to move overseas and work from the US over the next 3 or 5 years. He wants to know if this is the right time to start investing, or should he wait until later? And if he began investing in Indian equity mutual funds, what are the tax implications of being an NRI? That's an excellent question, Ganesh, and there's very little for you to worry about. I still recommend you start as soon as possible. But Feroze, what tax implications will there be?
The tax efficiency when it comes to mutual funds is significantly higher. On the equity side, taxation on mutual funds is absolutely, it's tax exempted if you hold an equity mutual fund for a year, which is an amazing benefit because there's nothing else in the country which is taxed at zero except agriculture for that matter. So to my mind, equity taxation on the mutual fund side post a year is 0%, and less than a year, which is called short-term capital gain, is taxed at 15%. But the other thing, which is the debt component, or the debt mutual funds as they call it, will have a little differential taxation. In fact, on the higher side, short-term capital gains is taxed at the highest tax slab, depending on your tax slab. And on the long-term capital gain side, which is 3 years, you'll have to hold a scheme in the debt category for 3 years to be categorizing the gains from it as long-term. Once you categorize them as long-term, the tax is 20% with indexation. So that indexation benefit of 2-3 year indexations can actually bring down your tax liability significantly. So debt taxation, because of indexation, comes down significantly. But yeah, it's basically a mutual fund is a tax haven to invest. So should you start when? To my mind, mutual funds, you don't have to time so much because they are a basket of shares. If you buy the equity side, if you buy the debt mutual fund, you have a basket of bonds. Since there's a basket, timing becomes irrelevant. So you starting right away, I think will have no harm, irrespective, as long as you have a longer kind of a time frame to get into equity.
All right, 66-year-old B.S. Rao wants to begin investing in mutual funds. He says he wants some funds that he can start investing in, and he also wants to know if debt funds give higher returns than fixed deposit. Well, if he's someone who's never invested in mutual funds before, we would recommend that he takes a slightly more conservative route, perhaps look at a balanced fund or so. And as far as debt funds are concerned, Feroze, obviously they're recommended to investors who should be using them over bank fixed deposit, but what sort of a higher return can he expect?
So it's very individualistic. If you are in the highest tax slab, definitely not a fixed deposit. A debt mutual fund will definitely give you 200 basis points more, that is 2% more, and that's a lot when it comes to debt. So that's completely dependent on which tax slab you are in. Lower tax slabs, you should be indifferent. If you're on the higher tax slabs, debt mutual funds would be significantly better if you have the capacity to hold it for 3 years. Then coming to what should you do with your money? In my opinion, since you have a large corpus and this could be your retirement corpus, I would say a large portion of the money also needs to be in debt. But if you look at the contemporary situation of how the equity markets are expected to behave in the next couple of years, I think equity should form a part of your portfolio, but not a very large part of portfolio, at least 30-35% should be in equity. So let me recommend to you a good mutual fund which will be able to manage risk for you and still give you a fillip on your overall portfolio return. On the equity category, you can look at an SBI Magnum Blue Chip Fund, a Birla Sun Life Frontline Equity. On the debt category, you have two kinds of debt funds. One are called the short-term fund. There's another which is called the corporate bond fund. In the corporate bond fund category, you can look at HDFC Corporate Bond Opportunities Fund and ICICI Regular Savings. These funds, how are they different? They give you a marginal higher return, but they take papers of smaller corporates as well, just like a mid-cap fund which would do in an equity category. And on the debt side, which is short-term category, you can look at UTI short-term fund and the Kotak bond short-term fund. So these 6 funds, all divided 1/6 each, I think will be a reasonable mix for your 80 lakhs, Mr. Rao.
All right, Feroze, thank you so much for answering our questions. Remember, if you have any questions at all, especially to do with your taxes, write to us. Email IDs at the bottom of your screen. And remember to file your taxes in the next 1 month. Otherwise, you're going to have to pay a fine. Take the help of a good CA if your taxes are a little complicated, but make sure you get it done on time. All right, that's a wrap on Investor's Guide. Stay in touch. Reach me on Twitter. It'll be my pleasure to hear from you. Thanks for watching.